Let's go. It's Friday. Welcome to the Educated Home Buyer Podcast. It's another random podcast. We're just popping up in your feed randomly. It's kind of like hide and seek.
As a pop by, Jeb? Does it call it a digital pop by?
Possibly, yes. I mean, it's
All
hide
right.
and seek. Can you
I
find
like it.
us on the internet when we're out there? Anyway, we're coming with a little weekly recap of what's happened this week, where mortgage rates are, to kind of help set you up for the weekend, to become the educated home buyer and to put you in the best position possible if you're out there shopping. So, Josh, let's throw up some charts here to make it really easy to go. You want to pop that on? I can't do it from my side.
Yeah,
It's already
I
in.
believe I just removed it. Now, that's what I did. I added it, but I didn't have the correct here. I think. Hold on, this is the one.
There we go. All right. So we talked about a couple of these things on Wednesday, but Josh, the most important thing out of anything we're talking about here is the fact that actually rates came down just over an 1/8%. Is that all we saw this week in with all that data?
So and here's the important thing. We saw 0.11 last week, 0.14 this week, and you go, oh, that's not very much. It's 0.25% in 2 trading weeks. And I want to point out the most important thing. I don't think the world is going to tune into Jeb and I here for these Friday weekend updates, but this is much better and much more timely than the Thursday newspapers quoting you the Freddie Mac primary mortgage market survey. That will show you over time, historically, directionally, what happened with interest rates. But they call lenders and poll them on Monday, and it gets published in the newspapers on Thursday. This is from Mortgage News Daily as of yesterday. You know the 2 sources we like, Mortgage News Daily, Optimal Blue. So that's real world, actual interest rates, people getting out there. So you're seeing headlines, oh my God, big run up, CPI was better, rates are a ton better. They're 0.25% better in 2 weeks. But with that, refi applications, Jeb, popped up about 5%. Purchase applications were actually down a little bit. Pretty much noise. Last week was up about the equivalent amount. We talked about it. If you were on the live on Wednesday, we covered CPI. CPI was the big mover this week. It was 0.3 month over month on both the core and the headline. The headline was expected at 0.4. The core was expected at 0.3. Year over year came down to 3.4. Still above what the Fed wants to see, but moving in the right direction. The day before that, we got some crazy mixed data. PPI, the producer price index, is much less important than the CPI to the markets, but they look at it. And it came out this month, the day before CPI. We had a very hot read. It was 0.3% higher month over month than expected, but the prior month got a monster revision of 0.3% down from what it was originally reported at. So from the market's eyes, nothing happened. We were hotter than expected, but then revised down. So a net zero, nothing there. In terms of what's moving the market, yesterday we saw jobless claims trending slightly upwards. So the 4-week moving average is up 218,000 weekly jobless claims versus 215,000 the 4 weeks prior to that. And then we saw that import prices jumped. I didn't get the data pumped in there, but it was a pretty big jump. Import prices rarely, if ever, moves the market, but it was a big jump yesterday. And with that, we saw a give back of some of the interest rates. Wednesday was absolutely our best pricing. Between then and now, we've given up about half of the gains that we got on Wednesday. And when we look at it, Jeb, we'll show on the chart here, we went from being firmly outside of that upward channel that we had talked about to kind of back at the bottom of it. We're going to need some more negative news for the economy, positive news for inflation. So either slowing jobs or improving inflation before we get the big improvement that everyone here is hoping for.
Yeah, one of the services we follow, Mortgage News Daily, more or less came out today and said we're kind of on an 11-day weekend, if you will, basically with regards to data. So there's nothing really important coming out, what you're going to see here in this next slide, where we look at what's happening next week. So next week, you can see there's, the things that are flagged yellow with the stars there. There's one on Monday. It's Powell's speech. You got one on Tuesday, again, FOMC minutes. So the Fed's minutes from the previous meeting. And then you've got, PMI for May, global PMI for May. So in all reality, none of these things are market movers, but because there's absolutely no other data out there, these things, if they came in better than expected, might move the market in a not in a meaningful way, but could help with rates. And then the same to be said the other way, but you're not likely to see any big improvements in either direction. I guess an improvement going up wouldn't be an improvement, but any big moves in either direction, rather, So we're just kind of in this. What happens in 11 days, Josh? Is it PCE?
No,
Because it would be too early for
it would be
it would
too
be
early for the payroll. So it's got
yeah.
to be
So
PCE, and then the following week we'll get
yeah,
payroll. Look at this economic calendar, Jeb. So Sunday night, Powell is
just Fed
talking.
speakers,
So
just speakers.
he must be overseas, and then Bostic, Barr, Waller, Jefferson, Bostic, Cosmer, Barkin, Waller, Williams. The important thing about why that's not important is they've all been out this week. They pretty much give different versions of their speeches at different places. They've told us we are not comfortable with the current trend of inflation. And until we see a nice inflection point and trend where we are confident that rates are going lower, we're not going to cut. So that's sort of a reaction to CPI numbers on Wednesday. On the show, we covered what the futures market is saying about Fed actions, and they're betting that we're going to get 2 cuts the remainder of the year. And the Fed's going, whoa, cool. You got one nice data point, and we're seeing some cracks in the employment data, but we don't want to see cracks. We want to see full blown real data where we've got 4.1. What does Logan say? 4.1 is where we need to get on unemployment before the Fed's going to be comfortable. And I think a break below 3% on core inflation on the CPI, and we're already better than that on PCE, but they need to see some additional movement. And someone, Jeb, yesterday had pointed out that if you look at the futures market is betting that the Fed is going to cut at the meeting that is like a day or two after the election. And you say, okay, that's cool. They stayed out of the way of the election. But if you do something the day after the election, it still looks partisan, like you waited until after the election to kind of put your hands on the scale. So their feeling is they're not going to do anything the day after. So while the data currently today may be telling us something, they think that they'll stay out of the way and one cut later in the year. So the big, like, what are we talking about? Just no clarity, lots of uncertainty, lots of things pointing one way, pointing the other. It moves fairly quickly. But with the chart you brought up here, Jeb, we like seeing on this one, the 10-year, you like seeing those red bars. The red bars means yields down, means interest rates going down. And we broke out on Wednesday out of that upward 2 red line channel. And what we saw yesterday is we bumped up right back to the bottom of it. And as of today, we are back inside that channel. So we do have, I believe it is the orange one there is the 50-day moving average. So we're just above the 100 and just below the 50. Hopefully that 50 pushes us down and we make that run and hopefully challenge the yellow line there at the bottom, which is the 200, which would get us, another 0.8% improvement. So it's important to know, like Jeb, the thing I like to point out is the media wants to hype everything. Rates spike, rates crash. They don't really move all that rapidly. And when they do, they do go up much faster than they come down.
Good stuff. Yeah. So, I still have us on the daily. I have us out of that channel. Still, I had us breaking and I still have us out. The weekly, I have us still in the channel. So the trend again is still up. But it's just, you can draw these things a couple different ways. It'll be interesting again with 11 days of no real data. The likelihood of us seeing anything again is minimal. So we just continue to be patient, continue to control what we can control. And that's really it. We're going to continue to watch the market. But Josh, with that, you're seeing Mortgage News Daily coming in, 30-year fix currently sitting at 7%. I know that to be higher than what you can actually get as a well-qualified buyer out there in the market right now. So as somebody that's well-qualified, what are we seeing? High credit scores, 20% down. What do rates look like?
Absolutely. I'm talking to a client here, listener to the show. He may be watching today, and we ran the numbers this morning. He's at 6.875, 800 credit score, extremely well qualified. 6.875, 0 points. So that's 7% is not a terrible rate. If someone's quoting you 6.99, 7%, they are in the range. We can do 6.875 as of today. I always go back. If you get someone that you connect with, that you're communicating well with, and you feel like they are a knowledgeable expert, I wouldn't chase 0.8% in interest. If they get to 0.25%, especially some of these loan sizes, $5, $6, $7, $8, $100,000, $1 million, 1/4% is a lot of money. 1/8% is not a
What did I do?
huge amount. You said you don't want to hear Josh. You just want to hear his voice.
I just don't want to see you. I just
don't want to see his face. You got a voice for radio, face for radio.
What happened here? Jesus, I can't figure this thing out. All right, you got to change it back.
I already fixed it. What are you doing? What are you looking at?
I don't know.
You got your. Come on, Jeb. Keep up with the program here.
It's not. It doesn't look like that on my side. It's weird.
Yeah, bad technology.
Anyway,
you must be on a Mac.
No, I'm on your damn PC here in the office.
Well, Jeb, apparently no one wanted the big update this weekend. We've only got 30 of you today. We do got a couple questions here, but if you have some questions, if you're out looking, you want to buy, you want to go to an open house this weekend, you have some questions, you want to know what's going on in the market, pop some questions here in the comments. But what are your thoughts, Jeb?
Yeah, I mean, I think we answer some questions and just keep it moving along. And if people come in, great. If not, we'll wrap it up and move along. So, Quinn is asking about Mr. Matt Graham. Asked the question of CEO. I guess, is he the COO too, as well as the CEO? I don't know.
He may be.
Anyway, we had Matt on the show last year, which I assume is who we're talking about here. But he said that he anticipates mortgage rates will lead the way, aka mortgage rates will drop before the Fed lowers. What would you anticipate for timing? So again, we kind of just went over that a little bit. Another person we follow seems to believe that the employment is the key driver, more so than inflation. And that if and when employment, Josh, you mentioned 4.1 on unemployment. I don't really remember that number so much as I do his 332,000 4-week average on the jobless claim. So we're currently sitting.
What did we just say? 218 is what we just have.
Yeah,
for
we're like average? We're at 220-ish, right? So we need unemployment to get way worse before you see the Fed really start to take hold with regards to that. But we have seen, even though the Fed hasn't moved, we've seen the the spread between the 10-year and the 30-year actually improve a little bit, which has allowed interest rates to come down, even with the Fed not moving, right? And so we've seen the 10-year improve. I think we just continue to watch, right? There's not going to be a lot of data. I think we all personally thought, not all, that we would have seen lower inflation in the first couple of months because we had bigger numbers coming off, and we thought that we would see them replaced with lower numbers. But in fact, what we saw was them replaced with the same numbers. And that's why inflation hasn't moved in a significant way, and why the Fed kind of changed their stance a little bit and said, hey, instead of 3 rate cuts this year, we're kind of looking more towards 1. And so I think that's what we're looking at the moment. And until something changes on the economic front, that's still the story. That's the story we're sticking to at the moment. But I'm not going against. I said in our forecast this year, I think you could see rates in with a handle below 6 at some point this year. I still believe that to be the case. I just don't know if it's 3 months from now or 5 months from now. So,
Jeb, on this question, what would you anticipate for timing? This leads back to a comment from the Wednesday live that someone watched the replay and posted a question, or not even a question. They said, you need to tell everyone that Fed cuts, Fed hikes do not lead mortgage rates. Mortgage rates are going to go where they're going to go. So Matt Graham, first of all, Jeb and I will always defer to Matt. This is his full-time job. He doesn't sell houses. He doesn't do mortgages. He sits there and he watches the news, the data, the market, and he's great at it. And great in the terms of he can disconnect himself from the emotions of it. He doesn't have a loan closing tomorrow. He doesn't have someone that wants to buy a house but needs the rate at a certain point. So he can be detached, he can be unemotional, he can be rational and logical. So we will defer to him and his knowledge of that market. But at the same time, relative to a typical realtor, typical loan officer, Jeb and I watch this much more closely. There is a value in having an expert on your side that can anticipate and give you some guidance on what this is going to happen. And 100%, the mortgages will anticipate. They started spiking up before the Fed started hiking, and they will trend down before the Fed starts cutting. It's just the way of the world. Those are bets made in the treasury market and the mortgage-backed securities market with people with real money on the line, and they can move and be more nimble and move more quickly than the Fed can.
There you go. Good stuff. The Chizzy twins. Says, I notice a lot of realtors popping more than 2 to 3 YouTube videos a day now. Is it bad, the economy for agents? It
Yes.
can be. Yeah, it really, I mean, the number of transactions is lower than, it's higher than last year, but still lower than what we would normally see on average. And I think, we've always said here on the show, or at least I have, and Josh kind of confirmed the same thought, is, the 80-20 principle, right? Pareto principle, 20% of the agents out there do 80% of the business. And I think it's probably more skewed to 10% of the agents do 90%, but in the market that we're in at the moment, probably skewed even further, where 5% are doing 95% of the business nationwide. And in some markets, it's even higher. And that's because it's, the agents that aren't full-time agents might get one here and there, but the ones that are, been in the business, have the relationships, have the past clients, those are the ones continuing to be able to do some business. I think we're all down for the most part year over year, but there's this belief out there, and there's a lot of coaches out there coaching YouTube, influencers pushing YouTube and whatever else. And there's this idea that the more content you put out, the faster you're going to grow, and it just, whatever else. And the reality is none of that has to be true, to be completely honest. But there's a lot more people trying to get on YouTube, trying to put out video, trying to stimulate business, right? It's like, hey, I'm not getting any business. Let me try this. Let me try this. The reality is it's like anything else. When it doesn't produce business in a short period of time, those people will be out just like anything else.
How long did it take? How long did it take for you to, like, let's go way back, 2013. We started making videos. How long did it take? Was it 2015, 2016 before you actually closed a deal off of those?
Oh, it's probably
bad videos.
Those videos were market updates primarily to my sphere, right? They weren't.
Yep. They were different than what you do now.
There was no thumbnail for to get attraction, so to speak. There was no title looking for, clickable title. So I don't know that I ever really got any business out of those. It was more so, hey, just stay in touch with the people that already you're doing business with.
You had the condo buyer in Huntington that he brought his buddy with him, and his buddy goes, "Oh, that's the guy from YouTube."
The hands guy. It's funny. I don't remember when that was. That was prior. That was probably 2015,
2016. Yeah, it was well before you actually grew the channel.
Yeah, no. And that wasn't even the time, right? That we were focusing on the channel. But nevertheless, it takes time. It takes time like anything else. It's another job. You guys know that. I mean, it's Friday. It's 10, 11 o'clock. I have other things I could be working on. Josh has other things he could be working on, but we're trying to stay relevant in the market and provide you guys with information you can use to make the best decisions. So Miss Taylor says an impromptu day live. We did one last Friday.
This is number
we did 3. One Tuesday, and then in including our Wednesday normal, and now we're doing one Friday. So I think the Friday is probably going to stick. The other day might move around a little bit. In fact, it might go away entirely. We might just be 2 days. We don't really know, but we'll continue to keep you guys in the loop. ZL says, what's the best way to search for homes that recently sold in my area? Property tax appraisal went up 10% despite seeing no home sold in my area in Zillow. So it might have gone up 10% from a while back, right? So some of these markets don't adjust immediately. It takes 2 years. They're looking back 2 years at the data, what's happened over that period of time in order to make adjustment. They can't adjust immediately every time because, again, the property tax records take a while to input, then analyze, so on and so forth. But I would say if you're looking at data like that, if you have a real estate agent, ask them, hey, can you pull up the comps in my neighborhood that, my market, and see what's going on. But the reality is the county's not using just homes that sold in your neighborhood to figure out your value, right? They're using, it's not that granular. It's probably a wider net that they're casting in order to figure out, where
Jeb,
values have gone.
It's not like they're doing an appraisal on your property. It is someone at the assessor's office sitting at a desk with a lot of data. So Jeb hit the nail on the head. Jeb, where's your button that says Jeb's always right? Jeb hit the nail on the head that it's not granular. It is not that granular like an appraisal is, where they're going to your neighborhood and 3 exact comps. They're using a little bit wider data and not actually doing an appraisal on your property.
I agree. Yeah. So contact your agent to try to get some. Zillow, Redfin, those are good sources to figure out what's closed. If it was on the market and it's closed, they're going to show it. If you have off market stuff, obviously it's not going to populate in there.
And reach out. We have access to a couple of AVMs. Shoot an email at info@theeducatedhomebuyer.com. I can pull an AVM, shoot it over to you. Maybe not any better than Zillow and Redfin, but different.
Yeah, actually, if you go on my website and look under, I don't know which tab it is, buyer, sellers, somewhere in there, you can actually, it says, figure out your home value. It's a service that we pay for. It's called HomeBot, and it basically tracks home values in your area. Now, like anything else, it's going to have some variation there. It might be accurate, it might be off by a little bit, but it kind of keeps the trend. The trend is the most important piece of that. But if you put in your address, it will update you. There's a lot of cool features you can do with it. So if it interests you at all, go on there, sign up. I think you just need a name and an email address maybe, and put in your property address, and then you can track everything else. Interest rates, everything. It's kind of a cool service. 2.0 Sport says, hey guys, if you have magic powers, who says we don't, Josh? What would you do?
My wife says I don't.
What would you do to the housing market? What would you want to see? So Josh, if you could do anything to the housing market right now, what would you do?
Decreased regulation and cost of development, but within reason. People say, hey, I'm a libertarian, open free markets, capitalism. There is a place for the government to ensure that we're not doing crazy things. But for us specifically in California, other markets have a lot more open land, a little less craziness. The geniuses in Sacramento decided that every house in California needs to have solar, and you have to have it at the time of closing. So builders, not being dummies, said, hey, this is awesome. They have to buy $17,000 solar systems from us, but we get to charge whatever we want. So the people are paying $35,000, $40,000 for $20,000 solar systems. So there's a balance. The government can't dictate things and not understand. We talk a ton on the show and the interviews we do with experts of unintended consequences. I believe that the ideas coming out of Sacramento, coming out of Washington, D.C., coming out of your state house, they're all well intended, but no one thinks about the unintended consequences. So for me, it would be lowering the cost of development, the timelines. We've talked about it was $100,000 to break ground. If you could get that down to $30,000 or $40,000, there is a place for regulation. It's excessive.
Yeah. Magic powers to figure out if I had a magic power to produce more land, right? I mean, that would help solve the issue. More buildable land in some
more
of these
oceanfront property.
More oceanfront property. Yeah. Throw some islands off the coast there that you could build houses on. I know in all reality, it's land, cost to build. Those are the key drivers of what would help the housing market. I mean, everybody said, hey, interest rates. Yeah, interest rates a piece of that. But if you just added more supply, the market pricing would take care of itself, and you wouldn't necessarily need lower rates to help drive it. So interesting question, but unfortunately, we're not going to get very far with that. Let's see, Josh. Cindy says, doesn't want to see rates drop right now, concerned that will just drive home prices higher. I don't disagree with that, but I do believe you're somewhere near the top end where prices can go because of affordability.
Disagree. Disagree. If you get a 2% drop in rates,
well, I mean, yeah, no. If interest rates go way down, no, I don't. I agree 100%. But that's not reality. That's not going to happen. If interest rates drop to 6%, I don't think
5% is a crazy interest rate. I'm not predicting it, projecting it, saying it's coming soon. It's not a crazy interest rate. There's a very simple scenario to paint where you're back at 5%, and she's right. But what I would say bigger picture is this is what happens. We talk about government intervention. The Fed stepped in, the government stepped in and said, we're going to buy all treasuries and push the yield super low. We're going to buy all mortgage-backed securities, push the yield super low. So they spiked prices to the moon. So prices are elevated and we have a limited supply of them. So people that want to buy them don't have a choice. They have to buy at these elevated prices. And if we lower the interest rate, now we are increasing the amount of people in the market that can afford. Still, it would be very limited historically, but you could double if we drop 2% in interest rates. You're probably adding at least double the amount of buyers into the market, and that would have an impact on prices. But you have to step back and say, we still want what would be happening if interest rates drop 2%? Inflation would be well in control. Other things would be kind of back on track. So you want all the things that would lead to lower interest rates. You just don't want the continued distortion of the housing market from 2020 and 2021 interventions of the government putting their thumb on the scale.
Agree. Yeah, I mean, if lower rates, the problem is there's a lot of equity, right? And people selling property to move up have a large down payment potential, right? So that helps cushion that blow of higher prices. And that, I think, is part of what would allow prices to go higher. If there wasn't all of that cash in the system, then you wouldn't have the ability to quote unquote overpay if there was competition and so on and so forth, right? So I don't know. The reality is we don't really want to see higher prices at this point. I know people that bought their houses recently want to see higher prices, but you want to see stability.
For those folks who bought recently, Jeb, I would love to see 2%, 2.5% inflation, so that if they need to sell in 3 years, they can get out without, unharmed. But I don't want to see any more 4, 5, 6, 7% appreciation.
No, yeah, you just need sideways movement for a period of time. How long? To be determined. But the craziness is what creates the problems, and it has the larger potential for something bigger to happen in the other direction, which we don't want to see that either, right? 2.0 Sports came in again with with another question here, Josh, and is talking about the inflation. Yes, that's what I meant to say. Reduction Act that was passed back in 2022. How has that bill helped to reduce inflation? So Josh, if I'm being completely honest, I don't remember the bill entirely. I do remember we spent a lot of money with the bill, but I don't remember what the bill actually included.
This was the final stimulus they passed. It's mainly infrastructure. So things that we probably need.
That's right. That's
mainly infrastructure. But here's my thing. And please, if you are a dyed-in-the-wool Democrat and you wear blue every day of the week, don't take this as a slam on Democrats, because I'm positive Republicans, if they'd been in the office, would have said something similar. But this is the dumbest thing that politicians do. They will label something the exact opposite of what it is. The Inflation Reduction Act. The government is going to spend a bunch of money. So no value judgment on whether we should be spending it and where it's going. But we're going to spend a bunch of money and we're going to reduce inflation. I mean, just please shut your mouth. That is the dumbest thing I've ever heard. And yet people looked at this and go, I'll call my senator, I'll call my congressman and tell them I want the Inflation Reduction Act. You're like, dude, it has nothing to do with inflation. They want this spending, which again, if we dig into this, there's probably things that we all go, yes, we need that. That's awesome. There's highway spending in there. We would all go, yeah, I need better highways. But there's also crap in there. And when we look at it, this is state level, but the federal government does the exact same thing. The government in California has a $40 billion shortfall in their budget, and they have, $25 billion they can't account for that they gave towards ending homelessness. That's doubled or tripled in the last 5 years. So it just, the labels and stuff on it. So if you're asking us to tell you what they did to reduce inflation, there was nothing in that even was intended to reduce inflation. It was, hey, we've got the public in support of spending money because we have this crisis. Let's tell them we need to spend more money and it'll fix their issues.
All right. There we go. Alexis is asking a question. She's a veteran. So thank you for your service. What is an ideal scenario for a first-time buyer to purchase a price at $670,000? Hard to say. I would say you have a debt-to-income ratio, probably ideal. I mean, the lower the better. But with VA, Josh, you can speak to this in more detail. Credit score, as long as you have above a 620, you're in pretty good shape. The higher, the better. If you have a debt-to-income ratio, probably under 40, 42%, 45%, somewhere in there, money in the bank, you're comfortable with the payment. All of those things are ideal, but that's not really, I don't know that that's answering your question. So Josh, anything?
Yeah. The thing is, it's a pretty narrow box when you're a veteran. 99 times out of 100, the VA loan makes the most sense. Zero down, no mortgage insurance, better interest rate than conventional loans. So that's the direction that you're going. Right now, 30-year fixed rates on those are lower than the adjustable hybrid 3-1, 5-1, 7-1 arm. So you're looking at a 30-year fixed VA loan. Get with a lender that's an expert and knows that stuff. Jeb was talking about for you as a homeowner, where do we want you to be? We've talked on the show a million times about doing loans at 70, 72. I have a listener to the show right now, pre-approved at a 72% debt to income ratio. And people go, that's nuts. Why would anyone want to do that? In his situation, he has $4,000 a month of income that cannot be used for qualifying. And when that income goes away, he'll be able to get a job that makes $6,000 or $7,000, $10,000 more. So he's not worried about that debt to income. But what Jeb's talking about, if you have a finite fixed amount of income, you want the debt to income as low as possible. You want your credit score as high as possible. We have a credit repair company that we work with. I was listening to a podcast with him on the way on the drive in this morning, and basically was just saying, even if you have 650, 660, and we say VA, FHA, no problem, not only not a problem, you can still get good rates. If we can get you to a 680, even better. If you're going to be a homeowner, if you look at the average credit scores of people buying homes across the spectrum, including FHA and VA, they've trended much higher over the last few years, including maximize your income, your stability of your career, getting your credit score as high as possible, debts as low. Those would be the ideal scenario. But in terms of financing, it sounds like you've kind of honed in on a price. We want this property at 670. You have a fairly narrow box. Make sure you're not using one of the big box veteran lenders because you'll pay a higher interest rate than you need to and more in fees. So check with someone local, check with a broker that has multiple sources, but hopefully that covers the question as much as we can answer with what we have.
All right, Josh, we're going to go for 2 more minutes, and we got a couple questions to answer, so they got to be quick. Let's see here. This one says, I just saw it. Where was it? I'm using up time. Francisco, we locked in our townhome on a 30-year fixed rate, 6.5%. Basically think the appraisal came in too low. Would it make sense to reappraise next summer to hopefully remove PMI? So if you see values continuing to increase, then yes, absolutely. Continue to follow it. Again, find a service that you like that tracks home values. We mentioned one on my website that you could, input your property. It'll track it, all that good stuff, regardless of where you're located. So track something like that. Stay tuned. Come in here and we can continue to answer questions like that. Josh, this is the one I was actually looking for. In contrast with new construction, ready November, they are offering a $15,000 incentive. Their lender wants to lock in and use the money towards points. I'd rather do a 2-1 buy down, but he says I cannot lock. So Josh, what are your thoughts on that?
I don't disagree with you on the 2-1 buy down. There is absolutely no reason why you can't lock a 2-1 buy down. You can lock a permanent buy down, but not temporary. But if you're kind of at loggerheads there in that the incentive with the builders lenders is so big right now that you can't go, I'm going to go to Josh, I'm going to go to Jeb, I'm going to go to whatever loan guy or girl and get an alternative. $15,000 is a lot of money. The only good side I can see here is I do believe rates are going to be lower at the end of the year. So for now, I don't see a big incentive in locking. And if they want to push you to lock, ask them, hey, can I lock on your stupid 30-year fix with the permanent buy down and then switch to a 2-1 buy down when we get closer to closing?
There you go. Good stuff. Gonna, finish it up here with a comment. Definitely like the random chats. Your notifications work great. Keep up the good work, guys. Hitting the like button is always good stuff. So if you haven't done so already, hit the thumbs up. Subscribe to the channel. If you are subscribed to the channel, you don't have the bell notifications on. When we go live like this, it will alert you. And we've been doing them randomly lately just to kind of get in a little bit more time, a few more reps, if you will, to give you guys some more information and just help guide you through the market. So we appreciate you guys. We appreciate the support. Take us out, Josh.
Hey, if you are looking at homes this weekend, you want a second opinion, you haven't been pre-approved, you're thinking of getting pre-approved. If you do not have a real estate expert, Jeb has an awesome network of pros around the country. No matter where you are, he can connect you with someone. As we talk about all the time on the show, it's not just 80-20, it's 80-20 of 80-20. You want a top 5% performer that can help you in your market. If we can't help you directly on the loan side, we can connect you with someone that can. If Jeb, you're not local here to Orange County, he can connect you with someone that can. And even if it's just a review of documentation, you have a lender that you like, regularly I look at stuff and I go, guys, you're in good hands. Perfect. And just sometimes that peace of mind makes people more comfortable. So reach out, info at the Educated Homebuyers, the referral link down below, whatever it takes, get connected with us. We're here as a resource. We'll be here live on Wednesdays, probably most likely every Friday or most Fridays to give you a weekend update, and we'll go from there. So as always, buy right, borrow smart, build wealth, enjoy the weekend. Adios.